Hello and welcome to Financial Statement Analysis, Lecture 11, Part C on Equity Investments. In the subject so far, we've learned how to value a company, and we've issued a buy, sell, or hold recommendation based on if our value estimation is higher or lower than the current market price of the share we're looking at. This is really useful if we want to then go and invest in that company. We have a good idea of what we think the value of the company actually is, and if the current share price is less than what we think the value of the company is, it might represent a good investment for us. In this section of the lecture, I'm just going to briefly talk about different investment options and different ways that people invest in the stock market. So one of the fundamental theories in finance is the efficient market hypothesis. And the efficient market hypothesis predicts that a company's share price in an efficient market reflects all known information about the company. So that means predicting a company's future returns will be nearly impossible because all the known information is already in the current share price. So all available information is fully and immediately implemented into the current share price. It would be impossible in a perfectly efficient market to identify mispriced stocks using just public information. That's why insider trading is illegal, because we want to make sure our public markets are fair and equal, and if they're efficient, the only way you could make excess returns is through insider trading, which is unfair, so that's an illegal activity you can't get involved in. So financial statements get released to the public, so that means as soon as they're released, people should be reading those financial statements and incorporating that information into the valuation of the company, and whoever can respond to it the most quick could actually make a little bit of a profit based on their superior knowledge more quickly than others. For most stock markets, especially in developed countries, there's quite a bit of evidence that markets are reasonably efficient. Now, we can't say they're perfectly efficient, but for large companies in America, for large companies in Australia, the UK, Canada, Hong Kong, Singapore, they're reasonably efficient, the pricing of these large publicly traded companies. So we can look at that. The market reaction to public announcements is very quick. Within minutes of new information being released to the stock market, the prices will have adjusted to reflect that new information. And when we look at professional money managers, such as mutual fund managers or superannuation fund managers, it's very, very rare to find any fund managers or investors who outperform the market on average over many years in a row. It's an incredibly difficult thing to do. There are a few rare exceptions to the rule. Warren Buffett's obviously one of the really famous ones, but the majority of money managers only perform equal to the market. That is, they don't seem to show any expertise or skill on top of just investing in a random draw of market stocks. This is an example of an announcement on the ASX. When news gets released to the market, it was good news that for Bellamy's, one of their restrictions on trading in China had been removed. The stock price immediately jumped up on that day. So new information to the market, share price quickly jumps up from that information. However, there is some evidence that markets aren't perfectly efficient. This figure here illustrates a concept called post-earnings announcement drift, and it's broken up companies into different deciles, and it's looking at how share markets respond to news. So when earnings are announced, day 0, when good news is announced, the share price does jump up. But then in the future months, it continues up. And then at the bottom decile, when bad news is announced, the share price does decrease rather quickly, but then it continues to trend down. So that provides some evidence that not all of the information is impounded into the share price immediately. Some information does take a little while to get impounded into the prices. So one of the skills that you've developed in this subject is learning how to value a company. And active fund managers, if they're a fundamentally based fund manager, they're going to have a whole bunch of people utilizing these skills to try and pick undervalued companies to invest people's money into. Active managers usually rely on some sort of security analysis to identify mispriced securities, such as the same sort of process we've learned in this subject. The bad news for you guys is the majority of actively managed funds do not outperform the market. It's a very difficult skill to be good at, to identify undervalued companies, especially at the top end of market. If we're doing it just for ourselves, trading our own money, and we're looking at smaller firms that don't have many analysts covering them, that don't have big money managers investing, we'll probably be able to find some undervalued companies. But as we start getting up into those top 200 or 300 companies on the stock market, it becomes very difficult to gain an edge. There's a lot of smart people investing in the stock markets, and making sure you're smarter and more informed than those people proves to be very difficult over the long run. So one of the key takeaways, as a accounting or finance academic, people often ask you how you should invest your funds. And it's quite a disappointing and a boring answer, but most academic evidence in finance suggests that the best way for the average person to invest their money is into passive management, which is just buying the index. So buying a share in all 500 companies in the All Ordinaries, or buying a share in all 500 companies in the S&P 500 in the US. So you're not taking a position on any individual company, you're just buying the market as a whole. And you can do that very cheaply because you don't have to pay managers their high salaries of millions of dollars a year to buy their expertise. So a company like Vanguard, they offer low-fee passive index investments. And most financial studies find that Vanguard funds actually outperform most active managers. By far the majority of active managers who claim they're very skillful at picking stocks get outperformed by just a low-fee product that just buys all the stocks on a weighted average. When we break down the active investor category, there's different ways that people do it. We've learned fundamental analysis. There's also quantitative methods or that get used in addition to the fundamental analysis, and also technical analysis that gets used. So technical screens or quantitative screens that get used in a lot of funds can be things like price screens or small stock screens. We've looked at research previously, and I've got a few papers in future slides. Small companies are shown to generate larger returns than big companies. Neglected stock screens, if firms are not covered by many analysts, they're more likely to be mispriced, so let's focus our investing on that. Momentum, companies that have had their share price increase over the last 12 months are more likely to continue having their share prices increase than companies that had share price decreases over the last 12 months. So companies exhibit some sort of price momentum. Then there's fundamental screens based on accounting information usually. Things like the price to earnings ratio or the market to book ratio. They're proven to also be correlated with company stock returns as well. So there's a whole bunch of finance companies who will use these kind of screens to make their investment decisions. Often you'll hear them called factor investing companies. Like in last week's lecture on cost of capital, we did the Farmer-French factor models. We know that small firms outperform big firms. High book to market outperforms low book to market. High momentum firms outperform low momentum firms. So these are all particular factors that get implemented in these investment strategies. This slide takes a figure from one of the research papers showing that large firms have a mean monthly return of only 0.89%, compared to small firms that have a 1.5% a month return. So there's a big difference between large firm returns and small firm returns. This is over many, many years, over many thousands of different stocks, these sort of patterns. And beta alone doesn't take into account all the difference. Similar for price to book or market to book ratios, the firms that are considered growth firms have much lower average monthly performance compared to the firms that are considered value stocks. Same sort of patterns occur when you look at high momentum versus low momentum, high profitability versus low profitability, high investment versus low investment. These are all the quantitative methods that can be used to try and pick winners when you're investing. There's a few other unique sort of effects that are found on the stock market that maybe explain returns. A lot of people are skeptical on these kind of results, but this paper finds that there's abnormally high returns on the trading day before holidays in 3 of the major stock markets. It's also in the UK and Japan. So sometimes share markets might be happy. There's a holiday coming up, so let's be a bit happy. We're a bit more optimistic, and we might buy a few things or pay a bit more than we otherwise would. Whether this is a real effect or it's just a pricing or a quirk in the data is hard to prove. This paper, and there's another paper that are very similar, is very controversial. Are investors moonstruck? Lunar phases and stock returns. A lot of people do believe in the lunar cycle in impacting on people's behavior. You'll always hear old wives' tale of when it's a full moon, people go crazy. Ambulance drivers will say all the craziest cases occur on full moons, as will police officers. Most of the time when people actually study this in an empirical fashion, they don't actually find anything. Hospital admissions are often said to be higher on the full moon, but when people check it out, it's not actually a real effect. This paper looked at the moon cycle and stock return, and they find that depending on the moon cycle, stock returns will actually change over time. And I haven't read this paper, but the other paper has some very good co-authors, some of the best professors at some top-tier US firms, US universities, and they've used data from right around the world, many different years, and they find the lunar effect seems to be really robust. No one can really explain why moon returns would impact stock prices, but there seems to be something in the data that suggests that they are. So with all the fundamental analysis we've done so far, the people who are doing this professionally, the sell-side analysts, generally most evidence does not support sell-side analysts actually having recommendations or forecasts that outperform the market. Most analysts' recommendations do not outperform the average market returns. However, that doesn't mean analysts aren't beneficial. They still do provide a lot of information to market participants that can be very helpful. So analysts are still very useful and helpful. However, sometimes they have incentives that don't align their forecasts with necessarily being accurate. And then similar story for fund managers. There's no consistent evidence that fund managers will outperform the market. The majority of fund managers will underperform simple passive index investing. Especially once you include their fees, most of them don't do a very good job. When you take into account hedge funds and investors that do really fancy stuff, again, once you pay the fees to these people who earn very big salaries, generally they underperform simple strategies. That's why one of the biggest trends in finance at the moment in the last few years has been passive investing. Vanguard index funds are getting trillions of dollars invested into them because people are starting to realize that the money managers that have previously had all their money aren't actually generating much value for their shareholders.